While the world is focused on the stock market, a subsector in the manufacturing sector is plunging. And the reason this matters is because this happens right before everything collapses. Now, this isn't something most people would even know about. The stock market doesn't even care about it. In fact, you wouldn't even see it on a price chart. But about 8% of all American workers, that's some 12.7 million jobs, are directly tied to the manufacturing sector. So when it slows down, the spillover effects are huge. And if you think about the risk here, what this means is directly we could see about 2 million jobs lost. Indirectly, that number goes up a whole lot. And if you talk about the timing for the economy, when we step back, we can see it's continuing to decelerate. And right now, if all these people started to lose their job, the economy cannot absorb them. And we see the evidence in the weekly continued claims data. We continue to see that more Americans are stuck on long-term unemployment. We're seeing in this survey data is not only manufacturers, but other businesses. They're pulling job openings, they're cutting hours, and in some cases, they're starting to cut jobs. But when you look at the latest U.S. data, I'm going to show you why this just isn't our problem. It's a global problem that could affect tens of millions of workers worldwide. Let's turn to the S&P Global Flash PMI. I want to start here. Let's look at the U.S. and we're going to take a look at the world, and I want you to see just how everything that's happening here is affecting everybody. Output and manufacturing are both down to their 2-month lows, but are still positive. But as you dig deeper into the data, what you find here is the real problem that's affecting the manufacturing sector. And the problem is it's backlogs. Let's take a look, because with backlogs of work falling, manufacturers cut back on their input buying in September for the first time since April. But this little bump back in April that everybody thought was really a sign of a turnaround, we were warning that if it rolled over, it was a danger sign for the economy, and sure enough, that's exactly what we're seeing. But when we look at the U.S. data, what we clearly see is that backlogs have been slowing down for 3 years straight. And the problem we're facing now, once they're gone, well, that means that a lot of businesses, particularly the manufacturing sector, are going to have to align their workforce with the amount of production they have. When that happens, my friends, the layoffs are just going to begin, and as all of those people lose their spending power, well, it's going to backfeed all across the economy. But there's a second issue here. Let's take a look, because higher production at a time of slowing sales was meanwhile commonly cited as the underlying cause of the largest buildup of finished good inventories in over 18 years of manufacturing PMI data collected. Inventories have now also risen in the past 5 months. Now, of course, they were hoping that if they built all this inventory at a lower price, that as consumer demand turned around and as the economy expanded, they would sell it at an even higher price and fatten their margins. But the problem is that's not happening at all. And so all this comes back to capacity and employment. And this is the real risk here. And again, this isn't something you see in the stock market. Well, at least you don't see it until things are too late. But let's take a look, because lower job gains we're seeing across both manufacturing and services sector. And manufacturing, the survey saw more of a focus on job losses due to cost. Now, I've been warning about this for a while, that as margins get compressed and profits roll over, which we've clearly seen is starting to happen in the data, that businesses will turn to survival mode and start trying to cut expenses. This is exactly what we talked about is happening in China. Let's take a look at some data from the Richmond Fed's Regional Manufacturing Survey. You see clearly new orders fell to -15 from -6, meaning there is a deceleration in demand here. How about employment? Decreased from +15 to -11, indicating they're laying off. Let's take a look at capacity utilization. It dropped from 1 to -18, meaning factories are seeing less capacity, and what that means is there's downward pressure on wages. You can see dropping from 22 to 13, meaning businesses are still giving out raises. The just size of them is shrinking, just as I predicted. Now let's take a look at this chart of capacity utilization against continued unemployment claims. You can see very clearly that as capacity utilization, that's shown in blue, decreases, and this is why this is so important. You can see the continued claims start to rise. And the reason continued claims continue to rise is because as people lose their job, their spending power drops. And again, that backfeeds all throughout the economy, as you can see throughout the different cycles here. And the risk right now we're facing is if capacity utilization takes another leg down, it means continued claims are headed up. Now, we just closed out a bunch of trades for huge gains, and you can do this too. Let's take a look at that trade on DAPP. It's up even more, now 19.88% as of yesterday's close. And again, that trade went back out on the 10th to all our subscribers. Now, as part of our optimized meta strategy, and if you haven't heard about that, well, we're about to make a massive improvement to it. We're going to optimize it on a per security basis. And again, we're changing the game when it comes to the way people trade. Stay tuned to the end of the show for more information. To get signed up and start grabbing these trades, all you have to do, hit those links in the description below and use a coupon code for your free 30-day trial. Let's take a look at another chart here of average hourly earnings of production and non-supervisory employees. That's shown in red, overlaid against capacity utilization in blue. And again, you can see as capacity utilization drops, well, with a lag, average hourly earnings drops right alongside it. Again, you can see the risk here as employees demand higher wages. Well, the economy isn't going to be able to give it to them because we just don't have the demand. But this isn't just a U.S. problem, my friends. It's a global problem, one that could put tens of millions of workers on the unemployment line, and soon. Let's turn to the UK. Let's start out with their global flash PMI. This from S&P Global. Here we can see the manufacturing output index at 45.4, hitting a 6-month low. And look at the overall manufacturing PMI, 46.2. That's a 5-month low. Now, the key point here, anytime you see it under 50, that's a contraction, meaning things are getting worse there. Let's take a deeper look because unfinished work was depleted in both the manufacturing and services sector during September, which extended the current period of backlogs to 29 months. So they've been working through this for a while. The latest data also indicated a decrease in private sector employment, which has been the case each month since October of 2024. So we can look back and see that as backlogs continue to decrease, the labor market goes right alongside it. Let's turn to the broad Eurozone. Here we can see the manufacturing PMI output is now at stall speed at 50.7, hitting a 2-month low. How about the overall manufacturing PMI? Slight contraction at 49.5, also hitting a 3-month low. So again, we go back to April, we can see clear signs. It wasn't just the U.S. economy, it was the global economy that started to roll over and decelerate here. Backlogs of work fell modestly and at the fastest pace in 3 months, again indicating there isn't enough new business to keep the workers busy. Manufacturing employment continued to fall, extending a sequence of job cuts, which began back in 2023. And again, it's all a sign of the global economy realigning demand with production. The issue we're facing is way too much production, way too much inventory, and way too many workers. And that's about to change, and soon. Let's turn to Germany, whose manufacturing sector has been in the slumps for a long time, but their output actually did get better, but right now it's decelerating to 52.2. That's a 2-month low. How about the overall manufacturing PMI? It's now back to a 4-month low at 48.5. So again, continued contraction means there's going to be a continued decrease in demand for workers. Inflows of new work were down in both manufacturing and services, as manufacturers recorded a steeper rate of depletion, that's in backlogs, and the quickest pace in 9 months. So once again, we see this recurring theme that there isn't enough new business. Again, not just a U.S. issue, a global issue here. Employment fell for a 16th successive month with a pace of decline at the fastest on record so far this year. So again, a lot of businesses do not have the financial staying power to hold on to employees. They've been pushed to the limits and they have no choice but to continue to lay people off as long as there isn't demand for workers. And again, this is the overlying issue for the entire economy. Too much production, not enough demand, and now we're facing a massive air pocket. And you can see we're getting very, very close to this happening. Once those backlogs run out, watch out below. And commenting on the flash PMI data, Dr. Cyrus de la Rubia, the chief economist at Hamburg Commercial Bank, said, quote, "Trouble seems to be brewing in manufacturing. Sure, companies have been ramping up production for 7 straight months, but new orders took a nosedive in September. Again, there's that air pocket we've been talking about. If demand, both at home and abroad, keeps dropping, it won't be long before firms hit the brakes on production too. And when that happens, my friend, there are going to be massive layoffs. Let's take a look at this chart of manufacturers' new orders versus the unemployment rate, and you can see very clearly this is what we've been warning about as new orders continue to decelerate. The unemployment rate, not just here in the U.S., as you're seeing in red, but all around the world, is going to go up, and it's going to go parabolic. You're going to watch it just surge higher, which is why we're going to see a lot of central banks cut rates. Let's turn to Fed's Bowman, who says the FOMC needs to act decisively to support jobs. Well, it's because they're behind the curve, number one. Number two, it's because rate cuts do not create jobs. Now that we've seen many months of deteriorating labor market conditions, it's time for the committee to act decisively and proactively to address decreasing labor market dynamism and emerging signs of fragility. In my view, she says, the recent data, including the estimated payroll employment benchmark revisions, so that we are at serious risk of already being behind the curve in addressing deteriorating labor market conditions. She went on to say, should these conditions continue, I'm concerned we'll need to adjust policy at a faster pace and to a larger degree going forward. And so you think back to where we started, I said, look, this is something that only happens right before a collapse. And that's exactly what I said about the last Fed rate cut. When they start to cut at this stage in the cycle, it's the beginning of a series of cuts, and it's going to be all the way back to zero. Because once you use the manufacturing sector, it's game over for the rest of the economy. But while it may be game over for the global economy, the game could just be beginning for your trading account, because we're changing the way people trade, and you can get in on that right now. Let's talk about the Metre strategy here. It is an advanced trading system that combines 9 professional strategies into a single intelligent signal generator. It creates 31 times more frequent buy signals, and it has a target hold period of 10 days. It generates over 155 signals per year and has a success rate well into the 60-some%. But again, we're changing the game right now. We're making massive improvements to this to put even more money in our subscribers' pockets. And this is what we're doing, because right now the Metre strategy is a one-size-fits-all, but it's optimized underneath. Right now we're working on optimizing on a per security basis. Now, what's the difference here? Well, let me show you what an optimized strategy looks like. Here is our Metre strategy looking back on a 3-year backtest on SPY. Here you can see total return 71%, beating a buy and hold strategy. It generated 69 trades with a win rate of 66%, had drawdown of around 7.5%. Now let's show you compared to an unoptimized strategy just run by my buddy Jay Bravo. He calls it Bravo 9. Now he says that you have to use a lot of other things to make his strategy work. Look at this, a total return of 51%, missing a buy and hold, half the number of trades, and look at that win rate. Well, pretty good at 51%, nothing close to where we're at, and the same drawdown here. Now, how do you get our Metre strategy, and how do you even get the new version that's coming out soon? Well, you've got to sign up for one of my reports. Now, if you want to trade against some machines, it's called CTA Timer Pro. We look at machine positioning every day and look at discrepancies and try to get you in ahead of big machine buying. But maybe you like to trade momentum indicators. Well, we pair that with a trend and call that Momentum Timer Pro. Regardless of which report you sign up for, you get all of the signals from that report plus the Metre strategy trades. You get my opinion on the best trades. You get risk control levels, a full tracking of all trades and returns, a weekly update, and here's the best part. You don't even have to put a dime out to try a report. It comes with a 30-day free trial. Whether you're new to trading or you want to compare us to your other reports, all you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Metre. Thanks for watching. Thanks for being fans. Bye now.